everyone. My name is Chris Kachmar. I'm a partner at Fiducient Advisors and serve as the firm's chief market strategist. Delighted today to be joined by Tiffany Wilding, Executive Vice President and North American Economist at PIMCO's Newport Beach offices. Tiffany heads the cyclical forum at PIMCO, and she also co-heads the firm's America's Portfolio Committee. Again, we're delighted to have her here today. We're going to address the topic of inflation, which has been a topic of particular interest to investors more recently. And let's get started. Certainly, Tiffany, there's this consensus view, I guess, among investors that this period of inflation we've had more recently is transitory and likely to settle in at a more kind of accommodating path, if you will, going forward. I did see your paper recently, The Great U.S. Inflation Head Fake, so I think I have a little bit of a hint of an answer, but where do you stand with just the prospects for inflation near term and in the intermediate term?
Yeah, well, so first of all, thanks for having me. So we are sort of firmly in this inflationary spike is just that, it's a spike, not a spiral. And I think to kind of dig into our view a little bit, I think we have to take a step back, and talk not only about inflation, but our view for the growth outlook, and in particular, the outlook for demand. Because of course, inflation and prices are set by, demand versus supply. There are some supply side issues that are currently impacting inflation, but I also think that there's a really important component here, which is the demand side that I want to talk a little bit more about. So in our most recent cyclical outlook piece that we produced, we actually titled it Inflation Inflection. And the summary that came out of that, or the conclusions that came out of that, was that we're hitting kind of the peak of the pandemic. We've probably already seen it. And as a result of that, we're also seeing peak policy and probably also peak growth. And because inflation, as I mentioned, follows demand and follows growth, we also are seeing probably peak inflation. So just on the pandemic, we have seen global 7-day rate of global new cases appeared to peak in April. We do think most DM countries will reach herd immunity over the next several months. So those levels of new cases should continue to fall. And that's even despite some lower vaccination rates in EM countries. But as I mentioned with that, you also are seeing the policy response to this pandemic that's also receding. So for developed markets, what we call the fiscal impulse, or kind of the amount of fiscal policy that's really driving growth, that'll actually turn negative. That'll be a headwind to growth later this year and into next year. So for the US, for example, which has been kind of driving the DM fiscal impulse, we aren't seeing additional, or we don't expect additional payments, pandemic relief payments to households. We got 2 of those this year, one in January, one in March. And in addition to that, we think, there's going to be an expiration of the enhanced unemployment benefits, for folks, which will also be a reduction in kind of that policy, impulse. So not only in the US and in developed markets is this happening, you're also seeing tighter conditions in China, which is also a very important market in the global economy. They have tightened monetary conditions. Their credit growth is actually starting to decelerate now. That has led global commodity prices as well as the industrial production cycle in the past. So that should be a little bit of a headwind. And then, of course, developed market central banks have either started to take the first step towards policy normalization in the case of the Bank of Canada, for example, who kind of started tapering earlier this year, or they're kind of laying the groundwork, plans to do so later this year, in the case of the Federal Reserve, which started talking about tapering. So all of this, in terms of our growth outlook, we think that this basically there's a bit of a desynchronized recovery in the second half of 2021, but this leads to more synchronized growth moderation in 2022. So what does that mean for inflation? Well, it means that inflation is also likely to peak. We think it sort of peaks year-over-year basis sequentially in May for the US. And it sort of settles back down. So our growth forecast for the US, for example, we have 7% growth this year, which is just massive amount of growth this year. That settles back down to closer to 3 to 3.5 next year. And with it, inflation, which we think will be around 3.5 core CPI inflation for this year, that sort of settles back down in kind of the 2.5 range for next year. So I think that, overall, we are very much in the transitory camp. I think there's a little bit more uncertainty around the outlook because we've also seen the supply side constraints. They're sort of well known and well telegraphed in the media. There's this issue with semiconductors that's impacted the auto industry and used cars in particular in the US. I think used cars are kind of running at a 30% annualized rate of inflation right now. That is not going to continue. We do think those kinds of issues ease along with demand in the back half of the year. And then in addition, there's just been logistical constraints because of the amount of demand. So ports just can't deal with the amount of ships that are coming in, and the US trucking industry, has some capacity issues for just literally moving around the goods from the ports to the end users and the consumers, and that's raising prices. So, all of these things I think are, they are lifting inflation now, but they will sort of start to ease in the back half of this year. And that'll produce a more transitory inflation spike as opposed to a spiral in our view.
You mentioned it a little bit, Tiffany, I think, but I wonder if it's worth exploring just a touch more. We've got this grand experiment on with central banks, just the amounts of stimulus and the efforts directed at the pandemic. Moreover, kind of joined by, obviously, as you mentioned, lots of in the way of fiscal support and stimulus. Do those magnitudes of those efforts, do they present unique challenges this time around in the way that the authorities will look to try to withdraw that stimulus, and does that have any implications for inflation potentially?
Yeah, so I think that's a good question. So I think in theory, the answer should be no, but I think in practice, the answer is maybe. And I say in theory no, because unlike in the past, when the Federal Reserve or the Monetary Authority set monetary policy through changing the level of reserves, or maybe changing reserve requirements, the Fed's no longer constrained by its ability to raise rates, by bank reserves in the system. So the Federal Reserve now, as many of you know, sets monetary policy through what it calls its administered rates, the interest on excess reserves, or the level of the interest rate in its reverse repo program. And this basically sets a floor on broader interest rates. So this will allow it to tighten if it needs to tighten. And in the last hiking cycle, I think the Fed really demonstrated a suburbanability of these tools to sort of effectuate policy and raise interest rates. But I said so that's the theory, but I said in practice, maybe, because I think that the Fed still wants to engineer a very smooth exit from ultra accommodative monetary conditions. And the reason why that is because if you have a disorderly repricing in the bond market, or in broader markets, that could sort of overly tighten financial conditions, and that could cause the economy and, of course, inflation to slow more than desired, and the Fed to eventually reverse course. So the Fed doesn't want to do that. And I think that arguably the unprecedented levels of fiscal stimulus that we've seen this time, as well as ultra accommodative monetary policy conditions, that's really sped up the recovery relative to what we're used to in the past. So that may require the Fed to start to normalize sooner and faster, than it did at least in the 2008 financial recession, in the wake of that. So I think in order for the Fed to do this, they're still going to have to engineer this relatively smooth exit in the bond market. But I think that's arguably potentially harder to do if economic conditions warrant, a sort of more abrupt or faster, sooner adjustment that's required. So I think it is a bit of a tricky task in practice, and that's the difference between central banking practice and theory, right? So yeah, I do think there is a bit of a task ahead of them in order to communicate, the potential risks here.
It's kind of on a related front. There's kind of this curious dynamic, right? I think on display in the labor markets right now, and certainly that you're well aware of. I don't think, right, the consensus call is for a full recovery in the labor markets. Maybe in the summer of 2022, we still have somewhat dampened participation rates. Does that whole undercurrent in terms of labor activity and related to the consumer play into this discussion around inflation at all?
Yeah, I think that this is important. And there's a couple of reasons for that. So first of all, I guess I should just say that, the media has focused a lot on what I would call labor market frictions, producing, kind of what the media has suggested is labor scarcity more recently. And that's a bit of a head scratcher because we still have, over 8 million jobs lost relative to where we were pre-pandemic. So kind of what's going on. So I think, currently, how I would characterize the labor market is that the pace of the recovery in different industries, as well as even different states or different regions, it's been very different. So in some states, some regions, and in some industries, we have actually very tight conditions because of this unevenness, while in other places they are very loose. So I think there are very much pockets of the labor market that are tight. But I think overall, the labor market still has a lot of underutilization. And there's also some issues that, I mentioned frictions. There's also some issues I think that are causing some near-term frictions. The couple of those that I would just highlight are, the people have been talking about the unemployment benefits as kind of a near-term disincentive to work. I think that that's certainly an impact that's impacting the restaurant industry, or some other, lower wage jobs that have very low costs to switching. The other thing is that we have had a disruption in in education. So there's a lot of folks that are out of the labor market because they are taking care of children. And then the final thing is I just think there's still a lot of anxiety around the virus. So jobs that are primarily public facing, some folks might not want to take them on because they still are worried about the potential health risks of that. So, we kind of see all of these things as somewhat temporary. Hopefully, as the economy reopens, some of these anxieties will fade. Folks, children will get back to school and other, forms of childcare. And of course, we know that there's going to be, some states have already allowed the enhanced unemployment benefits to expire, and in all states, they will expire in September. So overall, we think that labor supply will meet labor demand this year. We think it's possible that overall over the year, about 6 million jobs are created. But at the end of this year and into 2022, after those 6 million jobs are created, the labor market's going to look a lot tighter. And I think there's a question then over, how much more, wage inflation you're going to have to get in order to continue to sort of engineer these job gains. And I say that because although there's 8 million fewer jobs now relative to pre-pandemic, what we saw was actually a lot of retirements, associated with this pandemic. So people were kind of delaying retirement before the pandemic because the economy was so great. But then at the time of the pandemic, they were like, you know what, we're just going to go ahead and retire. So it's really unclear if those folks come back to the labor market. I think there's another issue here around the pandemic itself as well. And this is what these so-called long haulers, it's really tough to know exactly how many people those, estimates of how many people those are, and how that will affect their ability to work and come back to the labor market. So I think there's a lot of uncertainty around there. On the other side, though, just to be a balanced economist, I do think there's also, the current administration is well aware of these issues. And I think they're trying, they have policies, or they're trying to put in place policies to actually bring people back to the labor market. So the child tax credits that we're seeing this year, I think they're going to try to extend those in the infrastructure bill that we get later in the year. And in addition to that, I think there's going to try to be additional tax credits for childcare. So those things can hopefully bring people back to the labor market because they reduce the prices of childcare, and they reduce the cost of working, if you will. So I think all of those things are probably good, but I think there's a lot of uncertainty around how long that takes and how this will all play out. So we do think that you will see probably rising wages in 2022 as the labor markets look more tight. One other thing that I would just mention in terms of Fed policy, though, it's really important to understand how rising wages feed into rising prices. And it's possible that they might not feed into rising prices as much as some people fear. And I think there's two reasons for that. The first, is that this pandemic, in addition to the other stuff that it's done, it could have also increased the pace of innovations. So we could just see more productivity growth coming out of this recession than we have in the past. And of course, if businesses are more productive, that increases margins, and they don't have to pass on those kind of incremental costs in labor that they're seeing. And so you don't actually see the rise in prices associated with the rise in wages. The other thing is just you could also see some margin compression. There's been a lot of discussion lately over the secular trends towards what economists call lower labor share, or kind of the lower labor income, or lower the pie that's kind of going to workers versus going to capital holders has been shrinking. And of course, that's a main policy of this administration to try to reverse some of that. So if you get some ability of workers to get more of that pie, then that just means that prices aren't going to rise as much as well. So, overall, just to kind of sum that up, there's a lot there. I think that, the outlook is relatively uncertain, but that our view that the labor market, it'll look relatively tight. But in terms of feeding into actual inflation, we think it could be a little bit more mild. And we still think the Fed has a little bit more runway in terms of when they hike interest rates. And this outlook to us is kind of consistent with the Fed hiking interest rates, sometime in the second half of 2023. And of course, as we know from Fed officials' most recent economic projections, that's also consistent now with what they're thinking. But of course, we'll see. And I think on the margin, the risks are probably towards, sort of a more, maybe a faster pace here as a result of tighter labor market conditions.
It's interesting. You mentioned, Tiffany, a lot of those factors, I suppose. Pre-pandemic, we had this stubbornly low inflation, right? I think lower than maybe central banks would have liked, for all the reasons that you disclosed, right? Innovation, globalization, productivity gains, and the like. Is there a path where that could all kind of reassert itself, and we come back out from this slightly elevated inflation back at a run rate that's lower than authorities are comfortable with again, and we're discussing the deflation situation like we were pre-pandemic?
Yeah, I mean, so I definitely think that's a key. That's a very, very high likelihood, and in effect, like as I mentioned, that is kind of embedded in our expectations that the Fed will have some more runway to raise rates, even if the labor market is tight, because these other secular factors that you mentioned. But in terms of the Fed's ability to hit its inflation target over the longer term, really what matters there is really inflation expectations. So do people believe that inflation is rising, and is that actually impacting their decisions around the things that they purchase today? And so there's the theory would suggest that if inflation expectations are in line with the Fed's longer term inflation target, then they should hit it over time. So one of the issues, as you mentioned, we've had this kind of long period after the great financial crisis in 2008 of below target inflation. One of the issues with that is that inflation expectations kind of before this most recent period appeared to be drifting lower. And we've even argued that they were relatively anchored, but they were probably anchored below the Fed's target. So that suggested to us that actually over time, the Fed actually probably wasn't going to be able to hit its inflation target. And that we think was the catalyst to this monetary policy review that the Fed did, starting, I think it was 2018 that it started in, and obviously that it finished it last year. So that was a catalyst in monetary policy review, which basically said, when we have a period of below target inflation, we then want to target some above target inflation. So then over time, inflation averages around 2, inflation expectations really are anchored at 2. So I think that certainly, that is still the policy of the central bank. And as we've seen more recently, inflation expectations have kind of come back up, and they've come back up more quickly than expected, I think, in response to this kind of above target inflation that we're seeing now. So, overall, that all suggests to me that the Fed should be able to hit its target over time. But of course, we don't, there could be, any number of shocks to inflation, both, negative and positive. So it could turn out to be below. But it does look like, at least to us, the Fed should be able to hit its inflation target over time as a result of the current level of inflation expectations. But again, I mean, it's, of course, these are uncertain things, and the Fed will be reacting, as the economy evolves and as inflation expectations evolve with it.
You've captured a lot of stuff, so this has been great, Tiffany. I guess one last thought, perhaps, shifting gears a little bit. So if this consensus view kind of plays out, right, that we've got this temporarily elevated level of inflation, and then it settles back down at a manageable a rate, longer term, intermediate term. Big picture, what do you think, kind of from an investor perspective, things to be mindful of, markers, ways to kind of manage or navigate through this more unsettled time near term? Are there things to think about or focus on from an investment perspective?
Well, I mean, I think overall, I think the one thing that you can argue quite confidently, right, is that there's probably going to be more volatility in markets than what we've seen in the past. And the reason why I say that is just over our cyclical horizon, as I mentioned, we see several very important inflection points. You know, the pandemic, the policy, growth, and inflation. You know, we do think that all of these things are sort of peaking and they will start to decelerate. So we've seen the fastest acceleration in growth in the U.S., for example, you know, since the 80s, call it, but we're also now going to see one of the fastest decelerations as well. So these kinds of inflection points, we believe they will impact markets, and we will see higher volatility in markets as a result of them. You know, and against that, you know, that's kind of coming in the context of what we see as valuations across different asset classes that are, you know, are fair at best and rich at worst. So, you know, I would say just overall, you know, our view is to maintain a more defensive positioning within our portfolios, you know, to sort of position for this higher volatility and then be able to take advantage of it, you know, when it does happen. You know, we don't see, kind of looking across markets as a result of these valuations, I mean, we don't see a lot of really compelling, you know, investments, you know, currently, just from a, you know, a yield perspective or from a kind of a Sharpe ratio perspective. You know, and as a result of that, that's really why, you know, we like this kind of more defensive positioning. So dry powder for the volatility that we think is to come, you know, so we can put to work our clients' money to, you know, to the best of its use, you know, wait for those dislocations and then take advantage of them.
Mm-hmm. Great. Well, I think we're coming up. We promised listeners maybe about 20 minutes of your time, and this has been very illuminating for me and hopefully again for our listeners. And folks, if you've got questions for us, of course, get to your Fiducient Advisors professional, and PIMCO's site, of course, has a wealth of information that you can access as well. And again, thank you for your time, Tiffany, today, and everyone else be well and enjoy the holiday weekend. Thank you.